Good evening to all of you. Welcome to our class today. Now, what was that thing we discussed? Did we start off on how to manage the account receivable? Lillian, what was that thing we discussed last time we met?
Management of inventory.
Management of inventory. Okay. Did we do example?
Yes, we did.
Yes, and I think I shared some questions. I shared with you some for question from on the WhatsApp group.
Yes.
Okay. Then that's good. Okay. Thank you, Lillian. Okay, so last time we were discussing on how to manage inventory, okay, and I guess we did some few questions, okay. So today I want we start off and discuss on how to manage account receivable. How to manage account receivable. Now, when it comes to the management of account receivable, okay, we are going to go back to the two core objectives of managing working capital, okay, which is said the two of them, okay, they are to make profit for the business, that is profitability objective, as well as for the company to remain liquid, okay. So the two main working capital objectives, okay, are the two of them, okay. We have liquidity and we have profitability. So the same thing applies when we are going to be discussing on how to manage the account receivable. You're going to go back to those two objectives, okay? That is when it comes to the amount we are investing towards our customer. Don't forget, the receivable is the amount of sale you have made to a customer on credit that is outstanding at a point in time. Okay, that's what referred to receivable. Which implies, therefore, if you made a sale of good worth 10 million, it implies that for the customer owes you 10 million. That point in time, okay, they have your goods, okay, worth 10 million, okay, they have your cash in form of goods, okay, for 10 million, okay, which implies therefore it is an investment you're making, okay, it is an investment that you're making, which implies therefore you have to evaluate, okay, how much profit are you going to making out of this investment, okay, is it worthwhile for us to invest in our customer, for example, okay, so you have to evaluate on what is the return we are receiving, okay, as a business from the investment we made in our account receivable, okay. Of course, you have to consider on the effect it will have on your liquidity, okay. Now, the liquidity is essentially trying to make an evaluation of the company capacity, the company capability of being able to pay off for the obligations as and when they fall due, okay. Are you capable of, as a company, to pay for the obligations as and when they fall due? Okay, can you be able to do that? Okay, that's more towards the liquidity. Okay, but in fact, if you over-invest in your account receivable, okay, don't forget you have for you to get the cash, for you to convert that receivable into cash, you have to wait until the agreed point time. If the sale was on 90 days credit period, if the agreement between the chef and the customer is that the credit period is 90 days, it implies therefore you have to wait until the 90 as a company to be able to get back cash, okay, upon making the sale. So the longer you give your customer, the longer time period you give your customer, the higher the chance that you're going to be hurting your liquidity. You may be making a huge sales, okay, and by implication profit. However, don't forget that your liquidity, it might be decreasing. Okay? So it's about trying to strike a balance, okay, between the amount you invest towards your customer versus the amount you invest for your customer, the profit you make out of it, as well as the amount of the effect it has on your liquidity. Okay, so it's about striking a balance. As you mentioned, that the debtors, okay, on the account receivable is the goods or the sale you've made on credit that is outstanding at a point in time. Okay, so if you made a sale of good worth 10 million, the customer has paid you 3.5 million. It means you still have 6.5 million to go. Okay, the 6.5 which is outstanding is therefore the account receivable. Okay, so account receivable is sales made on credit that is outstanding at a point in time. Okay, that's referred to as the account receivable. Okay. And that's the number of factors that will influence the amounts that the company will be investing in their customer in terms of the sale on credit. One of them being, of course, the economic condition. Okay, suppose if the economy is doing poorly, okay, well, what do you expect? Most of the business, okay, they would want as much as possible not to sell on cash, not sell on credit. Okay, so if possible, the company, if the economy is doing poorly, will opt to sell on cash as opposed to selling on credit. Okay, but if therefore the investment we are making towards the account receivable will be decreasing. Okay, because why? As you see, the company is selling more on cash as opposed to credit. And also, I think this could be of the terms and conditions you have between yourself and your customer. What is your company? What's the company credit policy? What is the terms and conditions you have between yourself and your customer? Okay, if okay the company do follow what we call we shall be valued as a stringent policy, okay, as a stringent account receivable management policy, okay. Now this way the company is going to be a bit strict, okay. It's going to be more strict. It's going to be stricter compared to the competitor, okay. So definitely, therefore, when it comes to the credit extension, okay, the company is going to be very choosy, okay, to who they're going to be extending the sales to. Okay, the company is going to be very careful, okay, to who do we extend the sales to, okay. Which implies therefore, in a case therefore, the company sales are going to be the company sales they're making on credit will be going to be a bit lower compared to their funds. Okay, that implies therefore lower investment you make towards the customer on credit. Of course, comparative wise, you can check on also on the price. Okay, if you're to assume that all goods are the same, except the difference in price. Okay, most customers are going to be they're cost sensitive. Okay, that implies therefore, if your commodities are pricey, okay, and it is not that they're offering more, they have extra value. Of course, customer will shift from you. Okay, they'll go to your competitor. Okay, the same price, the quality. Okay, how is the quality of your product compared to that of your competitor? Okay. Do your competitor offer better services? Okay, if they do, then of course you're going to, for sure, customer run away from you. Okay, and of course if the customer you don't have customer, then how can you make sales? Okay, therefore all those some factors that may influence the amount of investment. Okay, that you can make, you can have on the account receivable. Another factor actually, which again I think we can mention this a lot, is on the financing. Okay, is on the financing. Okay, the financing angle. Okay, now when it comes to financing of receivable, okay, as mentioned, just take you back to the introduction we had. Okay, we say that at the end of the day, working capital, someone has to finance the company working capital needs. Okay, if you're making goods on credit, if you're selling goods on credit, it implies therefore that someone must have given you money for you to invest in inventory and now to be able to extend to your customer on credit. Someone must have given you, either a bank, either from the shareholders, either from the company past earnings, but there must be someone who is financing working capital. Okay, it implies therefore you have to consider therefore what is the cost implication, what is the financing cost. Okay, I will be incurring the company if whoever is financing me charges me high interest rates. Okay, of course I'll be very careful to who I extend the sales to. Okay, because they don't, when it comes to the sales you make to your customer, you don't earn any interest. There's no interest you'll be earning. However, you'll be incurring an interest cost. Okay, so since you're going to be extending the receivable, the sales on credits without any attached interest on them, however, whoever is financing you will be asking a return, will be charging you interest. But imply therefore you have to be quite careful. Okay, you have to strike a balance. Okay, between the profit, the potential profit you can make from the customer versus the financing cost you be carrying. The higher finance, if the finance cost is high, then that implies therefore you would want to ensure that you have a lower investment towards accounts receivable. If the financing cost is manageable, it's not that huge, then you may opt to extend even more sales to customer on credit. Okay. As I mentioned, the key thing here is that you have to more or less determine what is going to be the cost benefit analysis. Okay, you have to do a cost-benefit analysis. Okay, it will be a trade-off. Okay, compare the risk that comes with you adopting adopting a given policies was of course the profit you're making, the return you're making. So compare risk versus return. Okay, this is going to be the part of the return. Now this is the risk. Okay, so you have to compare the two of them. How much time do I receive from adopting this policy? How much risk will I be achieving from adopting this particular policy? Okay, and of course, since you are there to maximize your profit, of course, you'll be looking at a policy where you do maximize the return compared to the risk. Okay. As a company, definitely, you would want to ensure that you establish a policy, okay, that is going to be governing how you deal with your customer. Okay, that's for sure. You have to make an evaluation. What will be the terms and conditions that we hope we'll be having as a company and our customer. Okay, what are the terms and conditions? Okay, no, credit policy, okay, dictates what are the terms and the conditions the company shall be maintaining between themselves and their customer. Okay, so they're going to put in detail, okay, how the company or the nature of the company relationship, okay, between itself and its customer, okay, referred to as the account receivable policy statement. Okay, so more often than not, because it's worth enough that you have the statement or the policy, okay, written down, okay, to an extent that someone can make a future reference. Okay, if someone wants to make a sale and they want to give discount, they can refer back to the company policy regarding the credit extension. Is this customer worthy of credit or not? Okay, how much sale should I make to a customer with these particular features? Okay, how much sale do I make to a customer with a history of 1 to 2 months? Okay, with us. Okay, how much sale do I make to a customer who's saying not to have a good cash balance? So all these factors, you don't need to have them written down in a statement. Okay, what will be referred to as the company credit policy. Okay. As I mentioned earlier, the policy that you do want to adopt, okay, of course, again, be influenced by risk and return. Okay, of course, you have to consider therefore. Or you have to consider the profit you're making from the policy versus the cost that comes with that particular policy. Okay, as I mentioned, the policy that you're going to be adopting ought to be the one that you're able to maximize the return versus the risk. Okay, it must be a policy where there's maximum return compared to the risk. So the policy you're going to be adopting, okay, because I mentioned is going to be influenced by a lot of factors, okay, the demand of the product, okay, don't forget here we're trying to compare with the market, okay, what is the extent, how are your product demanded versus the market, okay, are you the market leader, okay, because in case you're the market leader, it means therefore that the demand of product is quite high, okay, which means therefore if the demand are high, of course you do most of the time, okay, you're going to be selling. You'll be avoiding giving sales on credits, okay, because the products are demanded, okay. Of course, the factor is the terms of your competitor, okay. In case you are in a competitive market, okay, then definitely you have to ensure that you do not let down your customer, okay. Ensure therefore you do want to ensure that you fight for the few customers that the market is offering, because you have many of you. You have this a lot of competition. So most often than not, you may end up matching the terms of your competitor. Okay, you may end up matching the terms of your competitor. If your competitor offers that day's credit, you may end up offering also that day credit. Even if maybe as a customer, you had a policy of only selling on cash. Okay, because the competition is giving the customer better terms. So you may end up matching what the other customers are being offered by the market. Okay. Then you have the risk of bad debt. Okay, the risk of bad debt. Don't forget, at the end of the day, one of the risks that you may have to assume as a company is the probability, the chance that some of the customer you have might become bad debtors. Okay, some of the customer you have might become bad debtors. Okay, it's a risk for sure. Okay, but in case if you have to make a sale, okay, and the chance of it becoming a bad debtor is more than them paying you money, then why would you want to make that sale? And it makes no sense. Okay. If a customer is going to be turned up into a bad debt, that's an expense to the company. It's a loss to the company. Okay, so if the risk is quite high, okay, that the customer might become a bad debtor, then you may want to avoid making that sale. Okay, you may want to avoid making that sale at the end of the day because you want to minimize your expenses. Okay, as I mentioned on financing costs, I think I already discussed on financing costs. Okay, you have to consider how much interest does the person who provides the company capital, okay, charge the company. If the cost is high, then you may want to avoid making high sales to your customer. Okay, if the financing cost is low, then as a company, you may be able to extend more credit to a customer because the finance cost, the financing expense, okay, is a bit low. Lastly is the credit control. Okay, don't get to the end of the day as a company, you will have to consider the admin costs that you do incur. Okay, the admin costs. Okay, don't forget you do require to have a credit control department. For most companies, they have credit control department. Okay, trying to control the credits that you do extend to a customer. Okay, so of course, having a department, it comes with a cost. Okay, there will be admin costs you've been carrying in maintaining that department. The salary you pay to the employees in the receivable department. Okay, the software you may be buying. Okay, to manage those customers. Okay, so of course there will be an expense being carried in trying to maintain that department to be operational. Okay, to still be operational. Okay, all these costs you are incurring because you are selling on credit. Don't forget the person who sells on cash does incur this cost. Okay, therefore you have to consider: is it worthwhile for us to extend the sale on credit compared to the cost being carried in maintaining the customer? Okay, in trying to maintain the sale we have made to this customer. Okay, consider therefore the admin cost you've been carrying. You have to consider the admin cost you've been carrying, the salary you'll be paying to the employees who shall make up that department. Now the policy statement. Question. Now the policy statement, of course, you have some what are called key elements. Okay, there are things that more or less should be there. Okay, there of course there are more things that ought to appear, but there are 4 key things that need to be to appear in the company credit policy statement. Okay, as we say that this is we conclude that this is a comprehensive statement. What should it be having? One of them is the company credit period. Okay? The policy statement, okay, as I mentioned, it governs the nature of relationship between the company and its customer. The first thing is on the credit period. How many days do you give to the customer who buy from you on credit? Okay, some company maybe have a policy, we give 0 days. In short, we don't sell on credit. That's the policy you can adopt. Okay, others can say we're going to be giving the customer 15 days. Okay, that is, the customers are meant to pay within 15 days of sale. Okay, it's a policy you have. Okay, others 90 days, others 60, others 50. Okay, so whatever it will be the number of days you want to extend to your customer the credit, you have to put it in that. You have to, it has to be in writing. Okay, it need to appear on the company credit policy statement. Okay, the company credit period. How many days are you going to be giving your customer upon making a sale to them on credit? When you have the discount, okay, the discount cost, one of the ways that a company may want to entice a customer to buy more, okay, or even to pay a bit earlier is on the discount. Okay, so company may offer discount to the customer, okay, 1% discount. So when it comes to the policy statement, for example, okay, we are going to give 1% discount. What must I do as a customer to get that 1% discount? Okay, you need to have it already known, okay, to the customer and say, okay, that we are going to offer you discount based on the following 1, 2, 3, and 4. Okay, that's generally a discount is only available to those customers, for example, who buy above 10,000 items per order. Okay, an example. Those customers who buy from us on cash only, the discount is only available to those who buy on cash. It's a proposal. Okay, the discount is available to those customers who pay us a month earlier than what is agreed. Okay, if the agreement is that they're going to pay in month 2, then agree. If you pay me within the first 1 month, I'll give you X discount. Okay, so it needs to be stated, okay, to all the different customers to get aware, to be aware of it, as well, of course, you as a company, the employees, get to be aware of it. the discount are only available to the following category of customer. Okay, the customer need to do 1, 2, 3, and 4. Okay. The other thing that must appear on the policy statement, okay, is on the assessment of the credit worthiness of the customer. When it comes to evaluation as to whether this customer is worthy of sale or not, you have to consider how do we evaluate that? How do we make that evaluation? Okay, we want to extend this sales to customer. Be careful that maybe this customer might end up becoming a bad debtor. Okay, so we are concerned definitely. Okay, we want to ensure that we minimize that risk. Okay, so those are the things that you need to look out for. Okay, so when it comes to assessment of the customer worthiness, what do you look out for? Okay, we can ask them provide you with their bank statement for the last 3 months. Ask them provide their last 3-month payroll slip. Okay, for example, in case you are banked and you have someone who want to borrow from you money. Okay, ask them to provide you with their previous 3 years audited accounts. Okay, so you have to have different way of trying to evaluate. Okay, if a customer is worthy or not. Okay, so you have to consider. You have to put it down that before we extend any single customer above 1 million. These are things they need to achieve first. Okay, they must have been a customer for the last 2 months. They must buy from us goods above X amount. Okay, they must have already paid their previous debt with us. Say all those examples. Okay, so those are what we call you as a company setting those credit standards. Okay, and of course, the trick is if an account is overdue, or even before it becomes overdue. Okay, the agreement you had with your customer is they're meant to pay you in day 60. Okay, the agreement you have between yourself and your customer is that they are meant to pay you in day 60. Okay, now what does that mean? And therefore, if now it is day 50, now you may want to maybe, for example, remind the customer that hey, your account is going to be due in 10 days time. Okay, so this is just a reminder to you. Okay, to prepare you mentally that in 10 days time we do require you to pay us some money. Okay, another way is if now the account is overdue. Okay, of course the first thing of course is to attempt to ensure the account does not become overdue. Okay, ensure it runs out of time in quote. Okay, if now by whatever chance it is, it becomes an overdue, it is now day 65. Okay, 5 days later, okay, the account was due in day 60, now it's day 65, so it's already overdue. Okay, now what do you do to ensure that you get that money? Because in case the account is overdue, the chance of it becoming a bad debt is increasing further. Okay, this is an expense to the company. Okay, so therefore you can consider what do we do to ensure we do get that money when if the account is going to be overdue. Okay, consider the use of auctioneers, for example. Banks do that more often than not. Okay, they auction properties of customer. If, for example, they fail to pay on time, pay what they owe the bank. Okay, so what policy? How do we ensure that you're going to get money from those accounts that are overdue? Okay, we want to minimize our expenses. Okay, we want to ensure that not all customer accounts bad debts. Okay, those are things that you need to state down. Okay, they need to be part and parcel of the company credit policy statement. Okay, of course you can have more of these for sure. Okay, so this is just a guide of the key features of an account receivable policy statement. Clear? Okay. Now, when it comes to the evaluation of the customer worthiness, okay, I already given where you can get the information from. Okay, you say that you can get the information from the bank. Okay, for example, you can ask the customer to provide you with their last 3 months bank statement. Okay, maybe to evaluate their worthiness, to evaluate their liquidity. So you can ask them, provide me with your last 3 months bank statement. Okay, to assess how liquid they are. Okay, ask them to provide you with their, if it's a company, okay, their published financial statement, okay. So we would expect that this company is going to already have set of accounts. They do prepare for sure, okay. They will provide us with your last 3 years audited financial statements, okay. And of course, we can also get information from trade reference, okay, from the suppliers, okay. So if, for example, you don't supply Utumi with goods, okay, and you are a company, you may want to check, has Utumi been paying the already existing suppliers? If they have not been paying, then how good are you that they're going to pay you? You won't supply it as case with some, I don't know, whatever product you won't supply them, okay? If they never pay those suppliers already existing in the system, how do you think they're going to pay you? Okay, so can get this information from the existing suppliers of the company, okay? Then, of course, you have also obtained information from the credit rating bureaus, okay, from the credit rating bureaus, okay? More or less the agency asking the customer, provide us with your CRB rating, okay? Credit scoring of customer of the company. Also, can check on the customer past, okay, the company past sales record, okay. Now, if this is not a new customer, okay, this is a customer who have been dealing with for this is not the first time in short, okay. If in the previous 3 sales you have made to this customer, they're yet to pay us, then why would you want to extend more sales to them? Well, yes, they never paid you the first sale, okay? They haven't paid you the second sale you have already made to them. That sale, and now this is the fourth sale, okay? Why would you want to make more sales to them, okay? So you can check on the customer trustworthiness, for example, okay, based on the past records, based on your past record with the customer, okay? If they don't pay on time, they don't keep their word, okay? They tell you we shall pay you in a month's time. In actual saying they pay you 3 months later, okay? Now, why would you want to make more sales to this customer, okay? So you can also use your own past historical record with the customer when it comes to evaluation as whether this customer is worth of sale or not. Now, as mentioned, there are 2 main policies that we can follow, okay, when it comes to the management of account receivable. You have called a stringent policy, okay, certainly referred to as a tight policy, and you have called a liberal policy, okay. Now, in the case of a stringent policy, now, if we are to compare, okay, let's compare with other firms. Let's compare with the industry. Now, if the industry is giving, let's for example, 60 days, okay, the industry, I mean other firms that have the similar operation, okay. If the other firms, the industry is offering 60 days, okay, of trade credit, okay. Now, you as a company that follows a stringent policy, you give in quote worse terms, okay, that your terms are not the best in quote, okay. When you apply therefore, if other firm give 60, you give 30. Okay, if they give 30, you give 15. Okay. When it comes to assessment of the customer worthiness, you're also going to be checking for more information. Okay, you don't just make a sale to any other customer. Okay, you are very particular on who you extend the sales to. Okay, so that when it comes to assessment of the customer worthiness. Okay, so the company is very strict on who they do sell on credit to. Okay, because they're trying to avoid to minimize the risk of customer becoming a burden, to minimize the bad debt expense. Okay. Now, all that, of course, has implication. Okay? It is going to have some financial implication to your your financial status. Okay. One of them, of course, definitely is in case you do follow a stringent policy. Okay. Since you are strict to your customer, and other firms seem to be offering better terms to them, of course, they're going to shift their loyalty to the competition. Okay, they're going to be buying goods from your competitor. Of course, therefore, there'll be a decrease in the company sales. Okay, and if the sales are decreasing, of course, profit is decreasing. So maybe therefore the end result will be a decrease in the company profit due to a decrease in the sale the company is making. Okay. However, being strict to your customer may have a benefit. Okay, one of them being the amount you invest in your customer is decreasing. Okay, don't forget, as I mentioned, when it comes to working capital, someone must finance working capital. Which means, therefore, in case you are strict to your customer, then the amount of account receivable outstanding is a bit low. And therefore, you borrow less money to finance this working capital. Which means, therefore, you pay less finance costs to the providers of capital. Okay. And also, in case you do, or in case you are strict to your customer, and of course, the amount of sale, the chance that those customers can become bad debtors also decreases. Okay, the chance they become bad debtors will also be decreasing. Okay, so therefore that's a good. The sound is a positive for the company. Okay, so of course therefore the key concern will be the reduction in the company's profit. However, there's also positive in it. Okay, positive one of them being the case of company decreasing its bad debt expense, and of course the company having lower financing costs. Why? Because they have lower account receivable investment. Now, a company may also follow what we call a stringent policy. Okay? May follow what we call a liberal policy. Okay, which of course is the opposite of having a stringent policy. Okay, a liberal policy we call opposite of having a liberal policy. Now, what happens here in the case of liberal policy is the opposite of stringent policy. Now, this firm is going to be offering generous terms to their customer, comparative compared to the industry, compared to other firms. If the industry gives 30, this firm gives 40. Okay, so it's giving more days to the customer. When it comes to assessment of the customer worthiness, the customer credit worthiness, of course, the firm will give me a bit loose. It's not so strict. Okay, the criteria the customer must first pass through the test in quote. Okay, is not that strict. Okay, which implies therefore the company sales will be increasing. Okay, because you don't also stick the customer. You offer better terms to customer. Therefore there will be an increase in the company sales. If the sales are increasing, therefore the profit will also be increasing. Okay. However, you're not being very strict to your customer. Of course, you expect there might not, or it's not going to end up very well too well. Okay, in that sector. For some of the customer, you may be you may excess sales to. Okay, might be unworthy customer. The customers who are not worthy of credit. Okay, which implies if they're not worthy of credit, that's what that means. It means therefore there's a high chance that they may become bad debtors. Therefore, the company bad debt expense may end up increasing. Okay, the company bad debt expense may end up increasing. Now, since you are extending a lot of sales customer on credit, you're offering them better terms. Okay, that means therefore you have an extra investment in the account receivable. You have a higher investment in account receivable relative to those firms that are strict to their customer. Now, if the account receivable investment is high, that means therefore more borrowings. Okay, you go to the bank more frequently, ask them to finance your operation. You ask for overdraft more than maybe once in a month. So the requirement of capital for you is a bit high because you're also extending that capital to the customers. Okay. Now, don't forget the bank is not going to give you money for free, so it will be charging a cost. It will be charging an interest cost. Okay. Therefore, the interest you'll be paying on the overdraft on the loans you've taken from the bank to finance this increase in the account receivable because therefore an expense to the company. Okay. So either way, either the alternative you're going to be taking has cost implication. Okay. Whether a stringent policy or a liberal policy, there is cost implication. Okay. So which one is better? It's about trying to quantify the financial cost and the financial benefit of the policy. Okay. So it's about you quantifying the cost and the benefit. Okay. If the policy offers more benefit than cost, then the company should adopt it. Okay. The company should adopt that policy. If the inverse occurring, where the returns or the benefits, the financial benefits are lower than the cost, then why should the company adopt that policy? The company should not adopt that particular policy. So simply going back to the financial benefits behind and the financial cost being incurred from adopting that particular policy. Clear?
Yes.
Question before we do an example? Okay, so no question. Let's do an example. So go through this in the next 2 or 3 minutes, then we attempt it together. Okay, I suppose that you've gone through the question, you have understood what the examiner was expecting out of you. Now let's do it together. This company want to increase or to offer their customer more days, okay, compared to what they are offering today. So currently they give you 2 months. They want to give their customer an extra 1 month, and imply therefore the customer pay on that month. Forget you give a customer an extra 1 month, then imply therefore you are giving them, you are extending, you are crediting to them longer. That means they have more investment you make to a customer. Of course, the expenses are still increasing. As you can see, still increased by 15%, and that implies therefore an increased profit. Okay, so that means therefore, since the sales are increasing, that implies therefore an increased profit the company is making. Okay, so we can begin here by getting the increase in profit. So increased profit. So increased sale can be there. Increased sale, the increase in sale, it will be 15% times the current sales 600,000 to give us a sales increase of $90,000. Okay, since the sales are increasing, of course, profit is increasing. Therefore, profit increase. In this case, profit is measured by contribution, so profit increase. This is as measured by contribution increase. And that the margin is 20%, that for every dollar of sales the company makes, 20% is contribution or gross profit, that is 20% multiplied by 90,000 to give therefore profit increase or contribution increase of 18,000. Okay, that is per year. However, don't forget, for you to achieve this, you're going to give your customer an extra 1 month. So more days you give your customer, more investment, more borrowing. Okay, so that's the next working. So this was not working 1. So working 2 is increasing the amount you invest to your customer on the receivable. So receivable investment, the amount you invest towards your customer. Okay, it's given us the number of days you give your customer. We divide by 365, the number of days in a year. We multiply by sales that you make on credit. Okay, so currently, how much do you invest? Currently, you give your customer 2 months. Okay, they're in months. So let me just read months. We divide by 12 months in a year. So 2 months out of 12 months in a year, you multiply by the current sales, which is 600,000. If currently the amount you invest toward your customer is 100,000. Okay, so at any point in time, if you have to make a stock to carry out analysis of how much customer owes you, it is equal to 100,000. Okay, so there's a proposal here. Okay, that we increase, that there will be an increase in company sales. Okay, by 15% by offering the customer an extra 1 month. Therefore, if we implement the proposal 3 months and 12 months, don't forget, after implementing the proposal, the sales is increasing by 90,000. So the new sales level is 690,000. To give us how much with the receivable?
$172,500.
172,500. Okay. As you can see, therefore, the amount the company is investing with the customer has increased from 100,000 to 172,000. That means, therefore, you're borrowing more money. Don't forget, as I mentioned, someone must finance working capital. Someone must finance working capital. So therefore, you can consider, therefore, what was the interest used to, what was the financing cost before? Okay. So therefore, the interest cost, okay, before, let me just call it before the proposal, not current, we just call it current. The interest cost you pay currently, you do borrow 100,000, And the person who finances you, how much they charge you? Let me just go back. The bank is financing you. Just a minute. Okay, yes, the bank is financing at a cost of 10% per annum. Okay, so the cost of capital is going to be a bank. Okay, this is financing at an interest cost of 10% per annum. To me, therefore, the amount of interest you pay currently is we multiply by 10%. Therefore, you pay 10,000 to be the interest. Now, in case you implement the proposal, you're going to be borrowing once in 2,000. Once in 2,500 times 10%. They give us 17,250. As you can see, the interest is increasing. Okay, so therefore, increase interest cost, because this is an expense of the company. Finance cost increase. We therefore 7,250. This is an incremental cost. Okay, which actually you could have obtained. Okay, by simply getting the difference. Okay, cost is 10% times the difference of investment. That is 172,500 minus 1,000 give us 2,250. So the same thing, but this one at least is easier because you avoid a lot of working. So either way, this is a cost to the company. This is a cost to the company. We compare with the benefit, which is a profit increase. Okay, so compare cost versus benefit. And you see that the profits are higher. The contribution is higher than the finance cost, the increased finance cost. Therefore, in here we have a saving. Therefore, net saving will be equal to the interest, the profit you earned minus the interest you are incurring, the incremental interest. Give therefore an interest, an annual net saving of 10,250. Therefore, should the company implement a proposal? Of course not. The company, of course, yes. The company should implement this proposal. Why? Because it will yield to an annual net saving of $10 to $50. So this is a good proposal. The company should implement it. Why? It yields an annual saving of $10 to $50. Clear? Question? Okay, seeing that was a very easy question. Let's attempt this one. Let's see how far I can go. First attempt it, actually. First attempt it. Let me see the answer you get. Example 2. Now in this question, what being asked by examiner is to determine whether this policy is a good policy or not. Okay. So here you want to give your customer a 2% discount. So you are the one giving the customer discount. Therefore, the discount you're going to give your customer is an expense to you. The discount you're going to give your customer is an expense to the company. So you can begin there. By the time, therefore, how much discount do you give? Are you going to give to your customer? Okay. So let me just take an image of this. Then we go to the board. Okay, so in this question, we told that the company wants to offer the customer 2% if they pay in 10 days. So the discount is the cost for the company. So discount cost to be to 2%. The customer will take the discount. We told that only 20% of the customer take the discount. So the sale you make to those customers is 20%. The total sale before the discount was filed was 10 million. Therefore, this is the sale of those 20%, and then you give them the 2% discount. Therefore, how much discount do you give them? 40,000?
20,000.
20?
40.
40,000. Thank you. Anyway, for the discount you're going to give to the customer is equal to 40,000. This is a cost to the company because you're the one who give the discount. So this is a cost to the company. Okay. Then you've been told that, okay, currently the annual sales are 10 million and the customer pay in day 90. So therefore, how much do we invest in our customer? Therefore, the next working is a receivables investment. So here, current policy, just call it current policy. We give a customer 90 days, so it will be 90 out of the 60. We multiply by the sales we make to them currently, which is 10 million. To give us therefore $2.5 million to the amount we invest in a customer. If we implement the proposal, we are told that 20% of the customer take the discount. Okay, 20% takes the discount. Therefore, we can say therefore the sales to those customers, we have done it here, is 2 million. Sales to the 20-day customer, let me call 20-day customer, is equal to 2 million, which is 20% of 10 million. Then we have other customers who don't take the discount, so they remain as they were, so they're not influenced by this offer. So they pay the customer, the company, in the 90. So they don't change their paying behavior. They're not influenced by this offer the company is coming up with. So you can have therefore the 90-day customer, which is now the balance, which is the 80%, because 20% pay in the 10. The balance, they don't change their paying behavior. Therefore, 80% of 10 million to give us 8 million. Therefore, you have two customers here. The one who paid in the, oh, this is day 10, not day 20. This is day 10, not day 20. So you have two customers, pay day 10, day 90. So therefore, the amount we are investing in those who pay in day 10 is equal to the number of days we give them. Okay. Therefore, so allow me to have some other work in here. So this is the receivable. Begin with the one who pay in day 10, let me just call it 10, will be 10 out of 360. We multiply by the sale we make to them is 2 million times 2 million. To give us how much?
55,555.56.
So therefore, the amount we are investing in those customers is $55,556. Don't forget, we also have the 90 days customer. Okay, so 90-day customer. Okay, 90 days out of 360. We multiply by 8 million. Look, they're 8 million, not 10 million, because now they're 8%. So times 8 million to give us 2 million. Total we are going to invest in is 255,556. That's the company total. Yes.
Excuse me, sir.
Yes.
I thought the sales for 2 million. These people, okay, it's okay, no problem.
Okay, so we get therefore the company total amount they are investing in the customers after is 2,055,556. Actually, you can also do it this way, or you can simply combine the two customers into one. We say that they have two customers, so their customer, therefore the receivables days, there's some customer who pay in the 10, but they're only 20%, they're only 0.2, so therefore times 0.2. There's some other customer who pay in the 90. How many are they? They are 80%. Therefore, the two combined, how long do the customer take out? How long do they pay you, the two combined? Okay, so it's a probability, okay? That's 0.2 of the customer pay you in the 10, 0.8 pay you in the 90. Now, combined wise, okay, how long do they take to pay you? How many days? 20? The two combined, how long do they take to pay you? The 10-day customer and 90-day customer.
74.
74 days, thank you. Therefore, the two combined pay you in the 74. Therefore, what's the implied investment you have made towards the customer? Is therefore, consider for the receivable investment implied is 24 days out of the 60. We multiply by, don't forget that we have combined them. Therefore, it'll be 2 million plus 8 million, 10 million we have before, times 10 million. Therefore, how much to invest towards the customer? 2 million, 55,556. Confirm.
true.
Yeah, so you may want to avoid, I don't know, whatever you prefer, so you can choose whatever method you think is easier for you. But simply don't forget here, you're trying to combine them into one, okay? Trying to get, on average basis, those two or three, they can be 2 or 3 category or even 4 category. How long do they take to pay the company? So on average, they take 24 days. Then you get, therefore, what's the implied work income, what's the implied receivable investment? 2,005,556. Clear?
Clear. Oh, sir, what about if you include the discount while you're doing the receivables of the 10 days people? Like,
So
you alter this one to now be less by 2%.
1.9 something, I want to guess.
Yeah.
Okay. Now, when preparing the accounts, when preparing the financial statement, how do you recognize the discount you give? Is it a separate line item or you reduce it from the company sales?
Yeah. It's a separate item.
It's a separate item. That's the same thing we normally do it here. So it's a separate item altogether. Okay.
Okay.
That's why you don't reduce it here. Okay. Thank you for asking that. So enough, therefore, we compare. What was the company investment before? 2.5. After 2,055,000. So you can see the amount the company is investing is decreasing. Therefore, the decrease. Therefore, since it is decreasing, then therefore you're saving money. Okay. Therefore, finance cost saving will be equal to the decrease, which was 2.5 million minus 2,055,556. We multiply by whoever is financing us, we're going to be requiring from them less money. Therefore, we pay them less interest. By how much? We determine whoever finances how much they charge us. 9% or 10%. Yeah, it is the bank. The bank gives us overdraft, where the bank charges us 10%. Therefore, how much do you save? 44,000. I don't know. What 4,444? That's the amount you save. So every year, if we implement this proposal, you save for 4,444. Now, this is a cost. Yes, this is a saving. This is finance cost saving. Let me just even be very explicit. It is finance cost saving. Now, this is a saving you're making. They go back and compare with the cost you're incurring. This is a cost, discount cost, 40,000. So, is there any benefit? What's happening? Therefore, there will be a net annual saving 44,444 minus the cost 40,000, give a saving of 44,444. Sharon, ask.
Where are we getting the 10% from? Is it the interest?
Yes, okay. Let me just show you. So here we are simply trying to make a comparison. What was the cost? Don't forget, before you used to borrow from the bank. How much you used to borrow from the bank to finance working capital?
Previously 2.5.
2.5 million times 10% because the bank is financing, but they charge you a fee, 2.5 million. After, you only need to borrow from the bank 2,055,000. So 2,055,556. So the bank give you go to the bank and borrow only 2 million at a cost of 10%. So you compare the interest you used to pay before and after. So here you used to pay 50,000. Here you're going to be paying 205,556 for the saving, 44,444, which you have here. Okay.
Okay. Yes, and what? And then the 40,000 is the discount we had.
The 40,000 is a discount you are giving your customers. Okay, this is a cost to you. That's why it's a minus.
Yeah.
So this is a cost you're giving your customers. So therefore, is a cash outflow. That's why you can see here we are subtracting. But this is a saving. Okay, this is a finance cost saving. So this is a plus to the company.
Okay, thank you.
Welcome. Any other question? Okay, now having done that, and then now we can advise the company. Should the company accept the policy or not?
Yes.
Because the company should accept the proposed policy since it yields an annual net saving of $4,444. Clear?
Clear.
Okay, that's good if it is clear to all of you. Now, having done that, I guess now we can go and check what the examiner asks of us. I sent you a comprehensive question bank. It's not very comprehensive, but it's good for now. Okay, so let's go through the examiner's question, see whether the question we can be able to do. Okay, so there's a question. So the question the examiner does in the most recent sitting. Yes, so if you check on the November 2019 question 1B. November 2019 question 1B. So go through it, then we attempt together. So Sumua Limited. So go through it, then we attempt together. November 2019 question 1B. Okay, so we've gone through the question, and you have understood what the examiner requires from this question. Okay, it's a very easy question, by the way. It's not that it's a hard question, but let's go through it so you understand what I mean by that. So you're meant to do as a company on whether this policy is a good policy or not, because you quantify the financial benefit and the financial cost. So first, as a company, if you implement the proposal, give me a minute. If you implement the proposal, there'll be an increase sales by 40%. So there'll be a 40% increase sale. So if the sales are increasing, then imply therefore there'll be an increase in profit. Okay. So if sales are increasing, there'll be an increase in profit. So if there's a sale increase, we will do the gross profit margin will remain constant. Okay. That's 25%. Okay, quite high, but assume that it's possible. Okay. So therefore we can get a gross profit increase. That becomes your first working. Okay, so increase in profit. Okay, so gross profit increase. Okay, so let me just take an image of the question to avoid back and forth here. Okay, so the sale increased by 40%, and we told that the current sales is 6 million. Therefore, the sales increase will be equal to 6 million times the rate of increase, which is 40%. That's the increased sale. However, 25% is the cost and 75% is the profit. We have multiplied by 25% to get the increase in profit. Therefore, what's the increase in profit?
$1.8 million.
Yeah, the increase in profit to be 1.8 million. Okay, so 1.8 million. That's done. Okay, so increase in profit 1.8 million. Then if we told that there will be an increase since the sales is increasing, we would expect there will be, since the total sales increasing, then we expect there will also be an increase in the company credit sales. So I think the next working is to determine the credit sales, and by implication, the account receivable. So current policy, the credit sales is equal to 80% of sales, so 80% of 6 million to give us 4.8 million. Then proposal, you've been told that the credit sales is 60% of all sales. So 6%, don't forget the sales here, they increased by 40%, okay? Therefore, 140% times 6 million times 60, therefore the credit sales. Give us how much? Okay, this 140%, let it very well. So 140%.
5,040,000.
5,040,000, therefore the new credit sales. Okay, as you can see, it is increasing from 4.8 to 5.5 for 5,040,000. Our key concern is the implied investment in the receivable. Therefore, we can continue the working. We determine, therefore, what is the receivable before and after. The receivable, okay, current policy. Current policy, you give your customer 45 days. Okay, therefore, 45 days out of how many days in a year? Not given to us. The number of days are not given to us in a year. So we can take the 60, 35, whatever I prefer. Let's take the 60 because I don't seem to meet the number of days in a year. Okay, the 60. The 60 we multiply by the credit sales then, which is 4.8 million. If we implement the proposal, okay, yes, in case we implement the proposal, the number of days for creditors will be equal to 30. You can see that there are 30 out of 360. We multiply by the new credit sales, which is 50/40. Therefore, what's the receivable before?
600.
600.
For 20.
Yes, 600,000 for current.
600,000.
Huh?
It is for 20.
Yes, 600,000.
For 20, 600.
For 20 for proposal.
Oh,
Yeah, for 20 for proposal, yes.
For 20 for the proposal, okay. So 600,000 was the investment we had before. For 20, if the company implement the proposal. Therefore, you can see, actually, the company investment is decreasing. So seeing some of the good news for the company. Therefore, a decrease equal to 180,000. So since it is decreasing, the company is saving. Okay. Therefore, the next working therefore can be the finance cost saving. Okay. Therefore, the next working therefore interest cost saving. Interest cost saving. Now, who finances the company? Is it a bank or who? Okay, not who it is, but the charge, you can see that the company cost of capital is 12% per annum. Okay, so the bank gives the company the finances at a cost of 12% per annum. Therefore, you save 12% times the decrease. Okay, it is 180,000. Therefore, how much interest do you save per year?
21,600.
21,600. Now, actually, I've seen here, there's a note here on the gross profit margin. Well, we need to revise this working we have done here. Because you told that if you check on the outcome after one of the those bullet points there, they're telling us the gross profit margin will increase to 80%. Can you see that? The gross profit margin increased to 80%. You see that?
Yes.
You see that bit?
Yes.
Yes.
So therefore, we need to revise our work in here. So we need to revise our work in here. So allow me to revise it. So what you can do is we determine what is going to be the gross profit. Okay, let me just call proposal and current. Let's be in the current. The current policy, the gross profit is 75% of total sales. 25% of the company total sales, which is 6 million. Give us 4.5 million. Confirm to give us 4.5 million to be the gross profit under the current policy. If we implement the proposal, okay, if we make the proposal, the gross profit will be 80% of the sale. So 80% of the sale, and the sale is 140, 140% times 6 million to give us 8.4. This is 8.4. The new sale
Yes.
Yes.
8.4. So then I'll just choose 8.4. So 80% times 8.4 million, the new sales to give us 6 point.
6.72.
So get 6,720,000 to be the profit.
6.72.
Okay, to give there for the profit. Thank you. To be the profit after. Now we can compare what was the increase therefore. Okay, and the increase therefore is going to be equal to 1,220,000, which I think was different from what we got after before, isn't it? It was quite different. And therefore, the increase in the company profit. Okay. Okay, so we've done that. Every collection. Then the next working can be on the bad debt. See the sum that
2.2.
Sorry?
It's 2.2.
Oh, 2.2.
2.2. Yeah.
2.2. Thank you. 2.2 million. 2.2 million. Thank you. So bad debt. So the next working can be on the bad debt. Now currently, you've been told the company, the bad debt average 3% of credit sales. So current, the bad debt is 3% of credit sales. We have credit sales here already. So times 4.8%, well, 4.8 million. Proposal, the bad debt will be 5%. Proposal, 5% times the new credit sales, which is 5,040,000. Okay. So therefore, what's the current bad debt?
144.
144. 144,000. The current bad debt. Proposal.
252.
252.
Yes.
252,000. The increase. 108.
Yes.
108,000. So that's the increase in company budget. So this is a budget. So this is an expense. So therefore, the company expenses will be increasing by 108,000 in terms of the budget. Okay. So we're done with that. The company will employ a consultant. So that's another expense the company will be incurring of over $1 million per year. We shall take note of that. Then the company, if you check on the that last bullet point there, the terms of credit are as follow: 5/15 net 45. In short, what it's trying to tell you is that if you pay within 15 days, you get 5% discount. However, you're meant to pay within 45 days. So in case you pay after 15 days, you don't get a discount. Is that clear? The 5/15, you get a 5% discount if you pay within 15 days. However, you're meant to pay within 45 days. Clear?
Yes.
Okay, because that's why most will normally say end up making mistake. If you don't know how to interpret that, then of course you can't get right. Okay, so this company is giving the customer discount. Then we have been told that all credit customer will enjoy the 5% discount subject to the term. So they get the discount, which is, I don't think it's very true. Because if they enjoy the discount, they're meant to pay in day 15. And the average, if you remember, they are up there. The average was told, we have been told, is 30. Then how? Those two statements by your examiner seem to contradict. Because how can they take account? How can they get that 5% discount if I'm not sure how that should be meant to me. All credit customer will enjoy the 5%. Okay, it might make sense by the way. All credit customer will enjoy the 5% discount. not they won't enjoy as per se, but they can enjoy, not they will. I think that's the use of that term they are saying to make it so. Anyway, so all credit customers can enjoy the 5% discount, okay? But for them to enjoy, they must pay within 15 days. Is that clear? Okay, so let's look at working here. You've been told that on average, okay, the customer take 30 days. So on average, if you remember, when we're calculating the average days for receivable, when you have two category of customer, okay, we have been told that on average they take 30 days. There's some customer who pay in day 15, the one who enjoy the discount, and there's some other customer who pay in day 45. Yeah, because they meant to pay in day 45. Okay. Now, what was the proportion of those customers who enjoy the discount? You have not been told. Okay. So you assume. Okay. Let me give a figure. Okay. Well, the proportion is X. Okay. Now, what is the proportion of the customer who don't enjoy the discount? Therefore, this is algebra, which I think most of you are very conversant with. What's the proportion of the customer who don't enjoy the discount? If the customer who enjoy the discount, I've just given it a variable here, okay, an unknown X. What's the proportion of customer who don't enjoy the discount? To be
1 minus X.
Yeah, of course, it'll be 1 minus X. It'll be 1 minus X. Okay, this is simple algebra. So, of course, therefore, you just make X the subject of the equation. Okay, therefore, this 15X. Okay, plus open the brackets 45 minus 45X. Okay, will be equal to 30. Therefore, this gives us 30. Okay, X is equal to 15. Therefore, X is equal to 0.5. Okay. Therefore, half of the customer enjoy the discount, half of the customer don't enjoy the discount. Okay, but they pay in day 45. Okay. Therefore, having done that, therefore we can calculate therefore the company discount cost. The company discount cost, therefore, you're giving 5%, and half of the credit customer take the discount. Therefore, the discount given is 5%, but not all customers take the discount. Half of them take the discount. Therefore, 0.5 times the sales we make them on credit, which is 50/40. Therefore, how much discount do you give to your customers?
$126,000.
126,000. If the amount of discount you're going to give to your customer is equal to 126,000. Okay. Anything else remaining for working? And no, I think we're done with the workings. Okay. Therefore, you can do a final analysis to determine whether this is a good offer or not. Okay. So we can begin with savings. So first, so we can begin savings. So saving you have here. There's an increase in profit. So here there's profit increase to 20,000. So to 20,000. So that is the gross profit increase. Gross profit increase. There's an increase. They're all incremental either way. So 2 million to 20,000. Okay. The sharing. This is the shillings, not dollars. Okay. In a saving you're making, interest cost saving is an interest cost saving here. So interest cost saving 21,600, 21,600, and okay. So I think the savings are done. So cost, there's an increase in bad debt of 108. So these are costs. So first is the bad debt increase of 108,000. So these are costs. Therefore, subtract. What are the costs? We're done with that. Go back to the next working. There's another discount cost here. discounts you are giving to a customer. Discount cost of 126,000. Then there's something about admin. You employing someone. Yes, you do employ a consultant and a cost of $500,000. Therefore, so this is just called consultancy fee, and you pay $500,000. I don't know if there's anything else remaining. Okay, that is it. Seems but to be more of a saving. Then what's the next saving therefore? Then you advise the company.
$15,07,600.
In what?
1,507,600.
600, 1,507,000.
507.
And 7, not 70. Thank you.
Yes.
507,600 shillings. So the company introduced this proposal. Of course, yes, the company should implement the proposed changes in the account receivable since it yields an annual net saving of 1,507,600 shillings. So it's a good proposal. The company should implement it. Clear? Question? Okay, no question. So maybe we can take another question from the examiner, because for sure most often than not, the examiner asks from this area. Most often than not. Anyway, let's check. So that was from the November 2019. So you can get another question. And this is a very easy one. I don't know whether it's worthwhile. Okay, let's read. This is the sitting after that. Before that was May 2019. So May 2019 question. May 2019 question. True question. It is question 2C. May 2019 question 2C. May 2019 question 2C. Go through it. We attempt it together. So if we suppose you have gone through the question, okay, and we can attempt it together. So in this question, we told that we need to make a decision as to whether this cash discount offer is worthwhile for the customer. So allow me to use Excel for this one. I don't have the solution and I want to store them. So allow me to use Excel. Okay, so this is May 2019. So May 2019, question 3C. So we can begin by, we've been told that sales will increase First, there's an increase in selling units of 20. So first, the current sales is 200,000 because the sales after is to 20,000, isn't it? Okay, the sales increasing increasing by 20,000, which implies that for current sales is 20,000, and the sales after is to 20,000. Okay, therefore, I think from there you can get the increase in the best way to use the revenues. Let's get the profit, gross profit. Okay, gross profit. I want to get the gross profit. So the work in here is to assess gross profit increase. So gross profit increase. You can see my Excel clearly.
Yes.
Okay. Okay, so gross profit increase. So we can begin by getting what's the current gross profit. I think that's the best. That's much better. We get current policy. Let me just call it current policy. The company gross profit. And the current policy, the gross profit is equal to the sales for the company currently is 200,000. So therefore, be equal to current policy. Let me begin by getting sales revenue which will be equal to 200,000 times the selling price. The selling price is 2,500. Okay, 2,500. That gives me therefore the current sales of the company. Okay, it's 12,000 times 2,500. Okay, and you get how much?
500 million.
Get 500. Get 500 million to be the current sales of the company. Okay, we less the variable cost. Don't forget, we were told that if you take on the note 1, variable cost 2,100, average cost 2,300. Don't forget, the cost will not be increasing. The 2,100 is what will be increasing in line with the increase in sale. The 200, the difference in the two costs must be the fixed cost. So it doesn't increase. Is that clear? The variable cost is 2,100. Cost per unit is 2,300, which means therefore the balance, the 200, is a fixed cost. So it is irrelevant to make a decision. So we don't need to include it. Okay. So therefore, our main concern is on the variable cost. The variable cost was equal to variable cost before was units of sale. So let me just pick the way it was times the variable cost per unit, which is 2,100. You give us how much?
For 2 million.
For 20. Get for 20 to be the company variable cost before. Okay, so that therefore you can see therefore the company, the gross profit therefore, okay, will be the difference. The gross profit 10 before the new proposal, which is equal to therefore 80,000. Okay. Okay, so that's the current policy. Then you can do the proposal. And the proposal, let me just replicate it because it's the same thing we shall be doing, only some slight difference. So the proposal, what is going to happen is that the revenue, the units are increasing to 20,000. Okay, so this is now to 20,000. Okay, here to 20,000. So I simply make the adjustment to 20,000. Therefore, the revenues after will be 550,000. Confirm whether that's what you get. Those will be 20,000 to 20,000 times 2,500. The selling price remain fixed. That's what it seemed to. 550?
Yes.
Okay. Then variable cost, look at the units now have increased. So therefore to 20. We multiply by the variable cost, remain at 2,100. Okay. Therefore, you can just to 20,000. You get first true?
Yes.
Okay, we get 42,000 to be the variable cost after. So comparing like what was the profit before and what is the profit after, okay, therefore this will be an increase in profit, okay, therefore here I can call it gross profit increase, okay, be the difference, okay. We see again equal to 30,000 minus the 80,000 to give us what to be the increase in the company gross profit. So be careful that don't include the fixed cost because it's fixed. It does not matter the selling price, the selling units, so they may not fixed. So be quite careful there. Once you get note of that, then it becomes easy to do the question. Okay, so that's on the gross profit increase. What else? We are going to give a customer 2% discount to switch from no discount to giving 2% discount. The next question that how many customers take the discount? 60% of the customers will take the discount. Okay, I think that's coming next working, get the discount cost. Okay, so discount cost. Okay, this will be equal to 60% of the customer. Okay, so 60% of the customer will take the discount, and of course, don't get it will be the new customers, not the old customer, because this policy was not there before. So it'll be 60% of the new customer. In short, the new sales the company is making, which is equal to 550 million, sorry, 550 million. Is that clear? 60% of the customer will take the discount, not the old customers, because we're giving the discount now. There will be 60% of the 550, okay? And you'll not be told whether they are on cash, so we assume all sales are on credit, okay? Then of course you multiply by the discount offer, which is 2% of your customer, which is 2% discount. Clear?
Clear.
Okay. Having done that, then of course, how much do you get? Therefore, the discount cost you're giving your customer?
6.6 million.
6.6 million. Okay, 6.6 million. And you get the discount cost to be equal to 6.6 million. Okay. What else? You're going to give your customer extra days. What is it extra? Well, the design. Okay, the design reducing. Previously, it was 60, it was going to decrease to 45. From 60 to 45. If that's the case, therefore, there will be decrease in the amount you invest towards your receivable, to your customer. Okay? Therefore, the receivable investment. About this current policy. Okay, so current policy is that we give our customer for 60 days. Therefore, it will be 60 out of the number of days in an year, which is 365. We multiply by the sales we make them currently, which is equal to 500 million. Clear? The number of days in a year, the number of days you give your customer on average, divide by this 5, multiply by the sales we make them on credit. Okay, which is in this case the entire sales of 500 million, 500 million. Clear? Okay.
Yeah.
And you get how much to be the current account receivable?
82,191,781.
82 million, just confirm, 82,191,781, okay? Well, for the company current investment towards the account receivable. Let's implement the proposal, okay? So under the proposal. On the proposal, you're going to, the number of days is decreasing to 45. Therefore, it will be equal to 45 days. It is now 45, not 60, 45 days. And the sales increased from 500 to 550. So we multiply by 550. So therefore, the receivable investment after, okay? Do you as how much?
No, 67,808,219.18.
7 million, okay? So we can ignore the decimal, okay? To give us 7,808,219, okay? We can therefore the receivable investment after. As I say, the amount you're investing is decreasing. The amount you invest is decreasing. Michael, ask.
Sir, I think statement 2 should affect that calculation. Statement 2. It is estimated that 60% of the customers will take the discount. Oh,
Yes,
what
it
am I
will.
saying?
However, the average, now see the earned, you see that statement 2, and the average.
Yes.
So you're already making the average already.
Ah,
You get it?
okay.
Yeah,
Okay,
because
I get it.
since it's already given, we don't need to calculate. It's already given to us. If it wasn't given, then you need to get the average number of days.
Okay, okay.
Okay. Therefore, it gets from 82 to 67. Therefore, there's a decrease. Okay. Therefore, you can say therefore this way was decrease. It will be equal to 87, 82 minus 7, and you get 14, 382 to be careful. Therefore, the decrease in the company investment in the receivable. Since this investment is decreasing, what does it mean? It means you save money because you'll be borrowing less money. So interest cost saving. Interest cost saving. So first, it will be equal to get the, whoever finances you, in Roman 2, the company requires 15% return on investment. So most is saying that for every investment they're going to make in, they need to get at least 15%. In short, whoever is going to give them money, expect a return of 15%. 15% we multiply by the decrease, okay, which in this case is 14, 383, 83, okay, 562. Therefore, the interest cost saving, okay, which will be equal to 15% times 14, the decrease, 1432, to give us therefore a saving of 2157, 534, an annual saving you're making. Clear?
Clear.
Yes.
That is it. No, actually, no, the previous question, there's something we missed because there was tax. Hope I'm sure you're working with me. So allow me just to go back to the previous working, because this is the gross saving, not net saving. Allow me to go back to the other question here. This is gross saving, because if you save, it means it's a profit you made in the company. Do you pay tax or carry for the savings you make? Do you pay tax?
Yes.
Yes, of course you pay tax. And here you made a saving, therefore you pay tax to carry. So the carry will be a trade return equal to 30%. I think they charge. Yes, if you check on that question, there's a tax rate of 30%. So you pay tax. So you have another cash outflow here. We ought to have included. So let me include it right now. Okay. Of course, the advice doesn't change, but of course the figures change here. So this is not the net saving. So this is a saving, but we need to tax it. So 30% of the saving goes to KRA as a tax. Then you have the net saving. How much tax do you pay?
$452. 208.
208 shillings. How much remain? 1 million.
55,320.
55,320. Anyway, the device made the same. However, we need to reflect the tax, okay? Because you made a saving. So it's a profit you made. So the carrier has to come and ask you, hey, pay the money. Anyway, so that was to make the adjustment. So anyway, going back to this question, now you also pay tax, okay? I think that's where you remember that we ought to have done the inclusion of the tax. So let's include the tax here. So going back to our Excel, what's happening? Okay, so you have a saving here. Then you have seen that in note 3, you pay tax. Okay, so in case you be a saving, you have to pay a tax. Okay, so I think there's no any further analysis. That is it. So we can now prepare our solution code. Okay, So let's see how the question will be like. So solution. So saving, can begin savings. So we have finance cost saving. So interest cost saving, we'll just call it interest cost saving. Then you just done here, which is equal to 2157. We have another saving. Gross profit was increasing, yes. So there was gross profit increase. Gross profit increase, which was equal to 8 million. I think you already know that. This, I think the savings are over. That is it. So cost you incur. One of them is the discount you give to a customer. So discount cost, which in this case is equal to discount cost. Where is that? 6.6 million. Is equal to 6.6 million. That is the cost you're incurring of 6.6 million. Then you get, I think that is it. Get gross saving. So gross savings in an year, okay, will be equal to simply the sum of those. That is the sum of the savings minus 6.6, the amount of discount you give to a customer. Then you pay tax because you made a saving. So here we can say tax rate of 30%. Okay, tax which is equal to, therefore, 30% of the gross savings you're paying. So there's a cash flow because you're paying. Okay, it's money out of the business. Therefore, you have here our net saving. Net saving in here, therefore, will be equal to 2.4 million to be the net saving. And where is the company? The company should accept or should implement this proposal since it yields an annual net saving of 24.90. Okay. Here.
Yes.
Okay, that is good to know. Now, we share time because we ought to have done another question. I seems that we don't have time for another question. Anyway, so the next time we meet, I think we'll need to some like another 1 or 2 questions, because this most of the time this is where the examiner is going to test. Okay, that's why I want us to have a good grip of how the question can be tested. So we shall come back here. We do some 1 or 2 questions. Then once we're done with working capital, because I think we remain with cash management and a simple conclusion, we need to do our cut. We need to do a cut 1. So prepare for cut 1. Okay. So I expect by the end of next week we shall have done away with the working capital, which means therefore the other week we can do a cut. So prepare for the cut the other week, not the coming week, but the other week. Prepare for the cut. And there's an assignment I gave you guys, okay? And I've received very few assignments from you. So in case you haven't done it, do it and send it to my email, okay? I will reply to the email you sent to me, okay? So hopefully before the end of the week, I will have replied with the solution, okay? Okay, then if there's no further question, I guess we can end the class there. Question? Okay, so in case there's no question, then I guess we can meet next week. Enjoy your evening and see you next week. Don't forget to sign.
Have a nice evening too.
Thank you.